The United States real estate market has been through quite a roller coaster ride this year. It started off with some steam, with sales prices stabilizing in several states and major cities, and a strong rental market still in place. But as soon as the health crisis struck America, things turned upside down. As renters lost their jobs and consequently their ability to pay rent, landlords started to fall behind in mortgage payments and default their loans. Then, in order to pay off their debt, several property owners filed eviction orders in an attempt to find paying tenants, leading rent prices to plunge to a level last seen in 2010. Conversely, ever since people started to massively relocate away from big cities, housing prices soared amid a shortage in the U.S. affordable suburban housing supply. Such unprecedented demand and the spike in housing sales led developers and brokers to eagerly anticipate brighter days in 2021. However, experts have been warning that the financial damage the real estate market has suffered due to months of mass delinquency in rental payments, in addition to the expiration of the CDC's moratorium and the coming eviction tsunami, could potentially trigger a catastrophic financial crisis that's likely to impair the sector's growth for years. Additionally, as natural disasters have become more frequent than ever, a market correction is looming, which means soon enough we'll be witnessing a crash. That's what we're going to discuss in today's video. So, stay with us and don't forget to give this video a thumbs up, share it with friends, and please subscribe to our channel to keep updated with the next chapters of the economic collapse. In the time span of only 9 months, the fallout of the COVID-19 outbreak reversed almost a decade of rampant rent growth in numerous major cities across the United States. In New York City, for instance, as a great part of the population ran away from the metropolitan area in an effort to avoid mounting social turbulence and the uncontrolled spread of the virus, as well as to find more affordable housing in safer suburban areas, the extraordinary amount of vacancies prompted landlords to give deep discounts so they could find tenants more easily and to meet their mortgage payments. The cuts, however, haven't been universal, and they were certainly not enough to help prevent the imminent wave of evictions that's about to push the most vulnerable groups to the streets. According to the listing website StreetEasy, in areas like Manhattan, which is known for having luxury buildings and elevated prices, the median rent dropped from $3,509 a month in March to an average of $2,776 a month in November, setting the lowest price since 2010. That configures a decline of 12.7% compared with the same time last year, which surpasses the biggest price drop registered during the Great Recession, when prices fell almost 10%. Even with mass vaccination in sight, it could take years for rents to return to pre-outbreak levels because of permanent job losses and a glut of luxury rental inventory, pointed out Nancy Wu, an economist with StreetEasy. The fact is that the biggest discounts were actually amongst luxury properties at the top of the market, so most parts of the population haven't benefited from it. As the affluent set has left the city for second homes elsewhere, the increase in vacancies has put several landlords on the edge of a financial cliff. As a result, they started to do desperate concessions with the intention of finding new renters, such as granting multiple months of free rent, waived broker fees, and other complimentary services at the owner's expense, maintained Beatrice Moitano, an agent with Keller Williams, New York City. It's absolutely insane, but I'm getting deals I couldn't believe the landlord would accept, she stated. But despite the concessions and discounts and moderating prices in some localities, a considerable amount of tenants across the U.S. remains delinquent and will stay that way as long as the economy hurts with lockdowns and they can't find opportunities to reinsert themselves into the job market. That's why analysts are expecting a tsunami of evictions to start as soon as the CDC's order expires. In the first half of 2021, there could be up to 40 million renter evictions nationwide, according to the latest Moody's Analytics projections. In New York State alone, chief economist Mark Zandi estimates there could be 590,000 evictions early next year, since only in New York City there are over 100,000 pending eviction cases, many predating the current recession, of which 14,000 had active warrants, meaning eviction could be imminent, stated Ellen Davidson, a staff attorney at the Legal Aid Society. And there are 40,000 cases, mostly filed after March, that could be at risk of a default judgment and eviction, because the courts have made answering the petitions in person, by phone, or online very difficult, she explained. Considering the moratorium is set to lapse on December 31st and some eviction cases are already proceeding, Davidson stressed that there absolutely needs to be intervention, because we will never be able to climb our way out of the financial crisis if there are hundreds of thousands of people evicted. But while low-income renters' housing security is on the line, on the other hand, affluent Americans started to move away from urban areas by the millions, and house sales became a sensation during the spring. The phenomenon, dubbed by analysts as the Great Relocation, was used as a symbol of big city struggles amid the ravaging economic meltdown. In turn, the migratory movement led housing demand to soar just as high as prices. "It was a rocket ship," exclaimed Jonathan Miller, a New York appraiser who also tracks sales in parts of Long Island, Westchester, and Fairfield, Connecticut. The trajectory from May to July was straight up. It was unprecedented. In Westchester County, the average sale price of a home last quarter rose to $680,000 from the same time last year, and that's a 20.4% increase, the biggest in more than 28 years. Miller said, with prices now at their highest in at least 34 years, buyers who bought at the peak of the frenzy should not expect to break even on a resale for 2 to 5 years, he asserted. Although brokers seem optimistic about 2021, citing low interest rates, rising demand, and the widespread distribution of vaccines now on the horizon, several real estate experts don't share the same enthusiasm. Throughout the year, multiple developments in the sector were compromised. Right before the outbreak burst, sales were sluggish, so contractors delayed projects they thought could be resumed later on. But after supply chains were crimped and construction sites were shut down for months, developers started to miss deadlines. And even as conceded advantages such as free common charges might have helped to soften the short-term blow, some condos are still facing a deluge of setbacks, including broken contracts, skittish lenders, and looming foreclosures. To say the least, the 1-2 punch of a slow market and paralyzed construction seems to have knocked many projects off track, which means the affordable housing supply problem won't be solved anytime soon. Therefore, steamy sales are expected to cool off over the next few months. "It was challenging regardless of the health crisis," said Shah Dinor, a partner at Hope Street Capital, a development firm. "And obviously the virus outbreak just made it a lot worse." In fact, the health crisis was definitely an unexpected natural disaster to hit the real estate market. But according to John McComber, a senior lecturer in the finance unit at Harvard Business School, our failure to acknowledge and confront climate change and several other natural disasters can also add to the list of reasons why experts forecast a collapse in housing prices and an ensuing financial crisis. In an interview with Harvard Business Review, the professor outlined that ignoring the threats associated with climate change may lead the market to a correction. That is to say, to another real estate crash. Macomber disclosed that the damage caused by climate change has accelerated faster than many people have anticipated. All across the nation, there were 16 weather or climate disaster events this year, and losses exceed at least $1 billion each, with some having registered much larger figures. From 2015 to 2019, the average is 13.8 of such events. 40 years ago, the average was 6.6. Today, we are facing increasing risks we couldn't foresee just a few years back. What has been raising the most concerns is that sea levels are rising. Therefore, coastal floods have become more frequent. The same goes for river floods from rain and devastation from wildfires. As the price of these properties drop due to increased risk of damage, home buyers become more vulnerable to do tricky investments, since it enables them to make or to maintain housing investments that are exposed to more danger than they realize. That's a classic market distortion. Especially for the time being, federal agencies absorb the extra cost of these risks by repairing or rebuilding these homes using the tax receipts from other property owners. But, as the specialist warns, insuring, repairing, and rebuilding properties that really are uninsurable has artificially inflated home prices by papering over this risk pricing gap. In other words, even though in the short run many can benefit from propping up housing prices, the exposure to material damage consequent of natural disasters and the eventual tightening of government budgets after so many trillion-dollar cash spills to boost the economy will make buyers' investments collapse. The question is whether it's going to settle out slowly or settle out fast. My concern is that all of a sudden it just snaps and there's this giant reset that leads to a real disruption in housing prices, described Macomber, pointing out that the greater worry is that insurance premium support will suddenly dry up, and at the same time mortgage underwriters will start to factor in the substantial danger of these exposures. The result will be a dramatic consequent rise in insurance premiums, coupled with a reduction in mortgage loan-to-value ratios, and at worst, the complete inability to buy fire and flood insurance at all, or to refinance a mortgage. In areas that face such risk, housing prices will inevitably plummet. Typically, for homeowners, the equity in their property is their biggest asset. So when that asset drops in value, or in the case of buyers going negative, when they owe more on their house than its risk-adjusted value, they get in big financial trouble. Additionally, it's important to keep in mind that most American municipalities get the bulk of their revenue from property taxes, which are tied to the value of homes and commercial real estate. So, if home values decline, property tax receipts decline accordingly in a city's expenses, and so does its ability to service its municipal bonds. In simple terms, it means that the ratings of the bonds risk being downgraded, which would lead cities to cut their budgets and create other stresses on government services, also increasing their cost of borrowing, leading the whole situation into a downward spiral. That's why a real estate crash would be impactful in all of our lives. It wouldn't just affect markets, but people's main financial assets, retirement portfolios tied to tax bonds, and municipal and governmental budgets. And on top of the financial and economic fallout, it would ultimately touch everyone's pocketbook, meaning it would exacerbate the economic deterioration millions are already experiencing, and the recession could be extended for much longer than we ever considered. Thank you for watching today's video. Don't forget to give this video a thumbs up, share it with friends, and please subscribe to our channel to keep updated with future videos.